Guys, today we wanted to talk about the meeting of the Federal Reserve on March 15 and 16, and then how it affect the housing market in 2022. Stay tuned with the channel.
But first, let's hit it. Hi, this is Alan Victoria. Welcome to our channel.
And if this is your first time in our channel and you wanted to know everything about Greenville, Winterville, and Pitt County, please subscribe in our channel and hit that ring bell to get notified when we put our new videos.
Honestly, I get calls, texts, and emails all the time from people looking to upsize, downsize, relocate, shift. My favorite word, shift these days. So if you're looking in this Greenville area, we love helping people, we love talking to people, and we'd love to help you too. So please don't be shy, call us, and we'll be here for you because that's what we truly love doing. But first, we're going to talk about the news.
Let's talk about the news. Therefore, we wanted to talk about this news and also the housing market really different, guys, in 2022, even the previous months in February and the previous year 2020 and 21, and we wanted to break it down for you. Please stay tuned with channel till end. We wanted to know if it's a good time for you to buy a house. No?
Absolutely. Okay, so the federal, what happened? Tell me what happened.
Basically, the Federal Reserve and this meeting, they decided to implement new monetary policy for according to the Open Market Committee. That what they wanted to do in March 2020, effective in March 17, which is we're recording this video.
Okay, so let me just break down what the Fed actually does. People, econ teacher, my kids did amazing when we did econ class. I love teaching AP economics. I had a very high pass rate every single time. This is actually a subject I love talking about. So anyway, I want to make sure people understand when watching YouTube, maybe you didn't have me as a teacher. So I want to kind of throw this out there that the Federal Reserve does three major things for monetary policy. They deal with the bond market, they deal with the interest rates charged between banks, and they're also going to deal with the reserve ratio, which is the required money that the bank has to have in their vault or on hand in order to cover their costs. So today, most people care about those interest rates because what does the Fed do? Fed does not control whatever mortgage company, whatever bank you bank at. The Fed controls how much overnight loans are charged when between bank to bank. So say you're going from Chase to Wells Fargo, like money is being transferred overnight in a loan. Now, the Federal Reserve has increased this by 0.25%. This actually does not affect mortgages directly. What it does is, will it affect more directly auto loans, personal loans,
basically the
short-term loans? Maybe you're only getting a five-year loan for a house. Maybe that's possible too. It's going to more significantly affect short-term. Long-term, now what we can say for mortgages, what we can see right now is that your mortgage is typically going to be 30 years, or 15 years. So these short-term rates don't directly tie right to mortgage rates are increasing today. In fact, the market has been bracing for these changes for a while now. So for the past month or so, interest rates have already creeped up. And so should it directly affect today? No, because they've already been expected this to happen. We knew it was coming. It's not like the interest rates are going to just jump like this overnight. Now, because the Fed has said today is the day. We knew it was coming. They planned for it. So are interest rates going to snap up today like thing? No. This is the relationship between federal policy and then our actual day-to-day lives is like not as like immediate impact. So I just kind of wanted to throw that out there that the Fed fund rate is, again, the interest rate charged from bank to bank. So this is the Federal Reserve kind of controls that, and then from bank to bank transfers, and this is where that interest rate does come in.
And basically what my wife trying to say, this equation of the Federal Reserve and how it's related to interest rate is not a direct equation that you say X equal Y. No, there are lots of factors that is involved in this which they right now they work on the short term. No,
right.
And you went 0.25%, and also we're gonna get news in the next meeting, which is gonna be May 3rd and 4th, which we're gonna update you again in those dates. That's what directly is going to affect this mortgage rate, the housing market.
Why? Because now we're going to look at what those 10-year treasury notes affect. So those are your longer term notes. Exactly. Most people are expecting that to go up. Again, we've been bracing for it for a while. So will it be an immediate snap of interest rates went up 1%? No, we've already seen it happening because people know it's happening or going to come down the line. So we've been preparing for it. Exactly. The Treasury security, again, this is one bonds. And I want to kind of quickly, I don't know if you are bonds later on your topic, or can I quickly throw in bonds?
No, you can talk about
quickly bonds. He sets the schedule. Just so we're clear, when you put money into a bond, you're looking for a secure savings that's going to beat inflation. The Federal Reserve controls this. So we want to make sure whenever you are saving money in a bond, a treasury bond, that your money, when you get the bond, is going to come out more than it was before when you put it in, based on inflation. So the Fed actually does control the bond market. It controls interest rates and it reserves, again, those reserve requirements. So this is kind of going to come into play more with the long-term reading in May that he is talking about, but not necessarily right now. So I just kind of want to throw
all what my wife trying to say in an economic term, for me that I'm not super good at economy, the objective of the economy really is the bond rate in the long run should be higher than the rate of the inflation, no?
Yes.
That is the short sentence for that.
Okay,
now we're going to talk about if this is a good time for you in 2022, in March 17, that we are recording this video, to buy a house.
And I just want to quickly throw out, when we started filming these YouTubes in December, I believe it was December, right? That there was typically like 100 houses in Pitt County that you could buy. So there was which is kind of low, but not the end of the world.
Therefore, you're talking about what?
December of just inventory.
Therefore, we are talking about now inventory.
Right. And I want to throw out, inventory now is actually lower. People think spring is better time to buy, but when we were talking around Christmas, there was like 100 homes for sale. Now in the Pitt County area, I'm talking all of Pitt County, there's probably about 65, 67. So there are actually less homes available, and spring is coming. So I just wanted to throw that out there. So therefore, we are actually having more competition.
To also address that, according to the Zillow, that is one of the big players, when we look at the January to the April, we have 1.1 million in whole United States inventory, and went down to 960,000 in December 2021, and now in the February and March, this number even went lower than 900 for whole US. Therefore, we definitely facing a huge inventory issue right now in whole US market.
Also want to throw in, just to add to that inventory woes, is that supply. Like the buying of windows and wood and everything we need to build a home and garage door openers, these are in short supply, and it's causing higher costs as a result. So the cost of build for new build is just going up. There's a demand out there because people need homes. We don't want to rent forever, and you don't want to live in corporate America where you rent from some big corporation. You want to have your own little space to where you're raising your family and doing whatever it is that you want to do, which is amazing and fun.
Exactly. Therefore, basically, we have two factors that causing the rate increases, no? Basically, was high inflation, that this didn't happen since 70. Therefore, in 40 years, that was the highest inflation that US faced it. And the second thing is economy recovering after the COVID-19.
Absolutely.
These two factors is basically the two most important factors and rating increase. Therefore, this is one note. The second note, as my wife said, the price went up significantly during the COVID and after the COVID. And my wife actually listed all these 3-4 factors: the supply, the demand, and high cost of the building. And now the question is, despite of this dramatical change in the highest rate, what do you think? Basically, we were talking about the interest rate relevant to now in March 17.
I don't see it affecting interest rates directly. Your average 30-year interest rate is already 4.46. Is it going to change a little bit?
4.46.
Not necessarily. Is it going to change? Will it change again? Maybe. I mean, I don't know the future, but will it directly change your interest rates today? No. 20 years are at 4.42, I think. 15 is at 3.66. 10 is at 3.14. 64. I forgot that one. And then the ARM is still at 2.96, which is low, but I don't recommend an ARM. If you're coming to us, I'm going to tell you don't get the ARM rate.
Therefore,
what is ARM real quick? Adjustable rate mortgage.
Adjustable mortgage.
I would recommend even if you're looking at 30 years at 4.46, it's still a safer bet than an ARM because you don't know what interest rates are going to do in the future. And with high inflation, interest rates are bound to go up. So it is better to lock in your rate, and 4s are still a really good number. I know we got spoiled in those 2s. We loved it, but 4s are still a great number. They were in the 5s not that long ago before coronavirus and all that. So 4s are still good.
Therefore, to answer the question that said it's the good time to buy, as my wife said, all of those items that we listed is actually try to boost up, raise the price of the houses, no? But if you're looking at the historical value of the interest rate before this 2020 and 21 that we had an amazing interest rate, but if you go back just 2 years back in 2018, 2019, we are still well below that average rate. And if you are looking at 2008 that we have a crisis for home and all those economy issue, they were above 5%. Therefore, you see, still with the rate that my wife said for 30 years, 446, still we are below that 2018 and 19 and 2008 that we were talking about recession. Therefore, this is one thing that we can say.
I want to quickly say, is now a good time to buy? I'm going to answer this simply quick. If you can find a house with a good deal, absolutely. Even if you are locking in those rates, because inflation is still a real factor. There are other factors that we cannot control, like war, Russia, Ukraine. I got no answer for that. We know the Fed is probably going to increase those interest rates again, so it's better to lock in something now. Maybe COVID comes back. Maybe some other crazy thing happens to us, because I don't know the future. Neither do you. Nobody knows. But we do know that being in your own place where you are safe and secure in your own home, to where you can do whatever it is you like. We're a couple, we have kids, we're raising our family in our home. And if you needed to change homes, it's going to be something because our family changes at the end of the day. And that's kind of why people move at the end of the day. It's because of your lifestyle and what you want. And so I think that's not going to change. You should hopefully have an amazing life. Get married because it's fun. Have children if that's what you want. And just have a great life. And that's what housing is here for you. And then we're here to help you make that biggest decision.
Therefore, to be itemized first, what I said is there was a historical interest rate. Mm-hmm. The second item that my wife talked about is basically the trend of the market right now, that we are uncertain and the market could be volatile, as my wife said, is Russia's war. That
I said the thing.
Yeah, I'm just itemizing it for our audience, which is the ripple effect on the financial world, stock market, and all those crazy things. And also looming effect of still prospecting resurgent of the COVID-19.
Hopefully not. I like the fact that I can go out again.
Therefore, this is another thing, as my wife said, all that is important beside of the mortgage rate is what? You look at your family,
and your
lifestyle, and the third one that I can say, the rent increasing constantly, 25% just the past 2 months.
And just so you know, landlords are betting that you stay in your rental and they can make money off you. So I do recommend getting a home, because then you are locking in your interest rate, your future, your 30-year commitment. It's not really a commitment. We have a different video on that. But you should get your own place and have your own, and then you're making your own money, and you're making interest rate, you're making the value of your house, so it increases, you get to keep. And so it's just a better deal all along.
Therefore, at the end is really come to your lifestyle,
absolutely,
your personal lifestyle, your financial situation that you are in your family, that you know better than us if this is right time financially for you. Because as my wife said, the landlord always wanted to make money off of you. Mm-hmm. And that's really help you to understand with all the items that we listed for you, if this is a good time for you, because we don't still have a crystal ball. We just listing for you the fact that, but up to you according to this and your lifestyle.
Okay, so amazing. Talk to you guys later.
And I wish you have a wonderful day. And if you found this information valuable, please subscribe on our channel, and see you in the next video. And don't forget to contact us to help you. Bye. Have a wonderful and amazing day. Bye-bye.